Some mixed economic data out this morning. Home prices rising for the fourth month in a row. But consumer confidence coming in weaker than expected in October. What's all this mean for the recovering economy? James Shug, senior economist, Westpac Institutional Bank, and real estate attorney Sherry Olafson from Fowler White Boggs. Sherry, start with you, because the good news was Case-Shiller. I mean, we now have the fourth straight monthly increase. All right, it's not seasonally adjusted, but it's not chopped liver either. Even the year-on-year declines have really moderated from about 20% to close to 10 or 11%. What's your take? Are we getting better?
Well, you know, Larry, in the big picture, sort of the bird's eye view of this thing, prices peaked in '06. They tanked really in April of this year, and every month since then we've seen an increase. But there are still some factors out there that have me concerned. We've talked about the foreclosures that are continuing due to unemployment and due to negative equity. We've talked a little bit about this tax credit for first-time homebuyers ending, that some people will have an impact. And the reason all of this is so important is because all of us are 70% of the economy, and you and I and Melissa, we've all lost a collective $13 or $14 trillion in home equity in this country. So until we all get comfortable with our own personal financial positions, we're not going to go out there and spend more money.
Yeah, I'm trying to spend. Hey, James, let me ask you, she mentioned the first-time homebuyers tax credit. They're talking today about extending that. Is that a little like the Cash for Clunkers program? I mean, when we do finally get rid of it, are we going to feel a hangover effect afterwards? Should we continue it? Should we scrap it?
For Cash for Clunkers, and it's interesting, in Australia we've also had a first home buyers grant. They extended that from June this year till December. What's already happening, even though that program is still ongoing, first home buyers have started to be less dominant in terms of actually taking out new loans. So they do have a bit of a shelf life, these programs, and our sense is that many people would have simply brought forward activity from maybe next year into the housing market this year. And even if they do extend the program, I think you are going to see a bit of a hangover. And indeed, that's why we're already expecting to see some weaker numbers on housing going forward. New home sales tomorrow, pending home sales next week. We've got minus signs in front of our forecasts for those indicators, partly because we think the housing market is, as Shari says, is going to be losing some momentum.
Sherry, let's go to the consumer confidence numbers, which were disappointing, and I think it links to a jobless recovery. What is your take on this? No jobs, not much confidence.
Well, that and also negative equity, Larry. I mean, in this country, at least 30% of the people are considered to be in negative equity positions. We've got a lot of people who are still paying on those option arms, which are going to start triggering resets over the next 2 years, and they're still paying the minimum payment, meaning that 90% of those people with those mortgages are very likely to walk away from their homes once their payments reset.
But Sherry, can I ask you, just to interrupt, it's not all about housing. I mean, we've had a terrific stock market rally, and roughly 100 million Americans, either directly or indirectly, are owners of stocks. Now, why wouldn't the stock market rally offset some of the housing gloom?
And it may for some people, but in the big picture, for most Americans, their homes were still, and we're still in that mental mindset, their single biggest asset. And to be upside down, I mean, picture yourself, the average American sitting in a $400,000 home that's worth $250,000 now, and they've got to make a decision. Do I consider making payments on this mortgage and essentially losing $150,000? And most people don't have that much money in the market. Or do I walk away from my home? And we end up in this adverse cycle with the foreclosures, where foreclosures, we've learned, are tied to all kinds of other markets in our country.
James,
Larry,
yeah,
can I come in there? I mean, confidence is off the floor. There's no doubt about that.
Right.
And it has reflected the improvement in markets over the last 6 months or so. What worried me about that report was the worst ever reading on how consumers feel about the labour market.
Mm-hmm.
Now, that doesn't necessarily mean that payrolls are going to post a bigger fall next week, but it is a further confirmation that unemployment in the US is still rising, and we're going to see a 10 handle on the unemployment rate before too long. The jobs component in the confidence report is a good leading indicator of what the jobless rate is going to do.
I mean, it is true. A year ago, in October '08, the consumer confidence level was 39. I'm rounding up. All right, the data come out today, October 2009, it's 48. So it's not as though it's a steady decline. We have seen some improvement.